And let me highlight the impact of corporate tax policy changes in stock markets. The impact of corporate tax policy changes in the stock market. Tax reform and changes to corporate tax policies have a significant impact on stock prices, as they directly influence corporate profitability, investment sentiments, and overall economic conditions. So here's how tax changes typically affect the stock market. Number one here is impact on corporate profits. The impacts of tax policy changes on corporate profits. So in this case, when we talk about lower corporate taxes, when government reduces corporate taxes, corporate tax rates, as the case may be, companies often see an increase in after-tax profits. This boosts, their earning potential, and in turn can lead to higher stock prices as investors anticipate improved profitability. Whenever there's a decrease in corporate tax, that reduction alone will go into the bottom line, boosting corporate profit. Generally, in a typical, accounting, procedure, you discover that generally, the higher the tax rate, the lower the profit after tax. The lower the tax rate, the higher the profit after tax. And so whenever there's a lower tax, rate, discover that automatically it will boost profitability, positively. Not only that, it's higher corporate tax. How does higher corporate tax influence stock prices? Conversely, higher corporate taxes reduces companies' net income, as I earlier explained, leading to lower earning projections and potentially driving down the stock price. So companies may also face higher operating costs, which can negatively impact their growth. Number two is investor sentiment and market reaction. Investor sentiment and market reaction. And so positive reactions to tax cuts. Let's look at positive reactions to incidents of tax cuts. So investors often view tax reduction, particularly corporate tax cuts, as a sign of more favorable investment environment, prompting increased buying activity in stocks, especially in sectors with high tax burden. Example, technology, consumer goods, as well as manufacturing. Let's equally, consider negative reaction to tax increases. Negative reaction to tax increases. In this case, tax hikes, especially on corporations, may create uncertainty and reduce investor confidence. Investors often sell stocks in anticipation of lower future earnings or market volatility. Whenever there's an increase in tax rate, investors will envisage a lower level of profitability, will sell off their stocks, and that would cause stock prices to plummet. So that's a negative impact of tax increases. Number two is a sector-specific impact. Let's look at the impacts as per certain sectors. Sector-specific specific impact. So in this case, you consider growth stocks. In the growth stock segment, the growth stock space, growth-oriented sectors such as technology and healthcare, benefit greatly from lower corporate taxes, as they are often, high tax and sensitive to changes in tax policy. Not only that, there's dividend, the dividend stocks. In the case of dividend stocks, there's these lower corporate taxes may increase the amount of capital companies can return to shareholders through dividends or buyback, boosting stock prices in dividend-paying sectors like utilities and consumer staples. You discover that whenever there's a decrease in tax rates, companies are able to pay out more dividends, and the more they pay out more dividends, the more it attracts investors to that particular sector, and that would boost the stock price. There's a cyclical and capital-intensive sectors. Cyclical and capital-intensive sectors. So industries like energy, construction, and industrials may also benefit from tax cuts that improve cash flow, enabling greater capital expenditure and expansion. Not only that, number four, there's stock buybacks and dividends. Stock buyback and dividends. Stock buybacks and dividends. So discover that certain whenever there's increase in share repurchase, when a company wants to or decides to repurchase its shares, there's lower taxes can provide companies with the extra cash to embark on stock buybacks. And there's also higher dividends. With lower taxes, companies may be able to provide higher dividends to their shareholders, and the more people get paid through dividend, that would attract dividend seeking, income seeking investors to that particular sector or that particular company, and the company will experience a boost in a stock price. Number five is capital investment and business expansion, capital improvements and capital investment and business expansion. So in this case, there's an incentive, there's that incentivized investments, incentivized kind of investment. So discover that lower corporate taxes often incentivize companies to increase capital investment because they can really, they have sufficient cash at hand to be able to increase their investment, increase their R&D, expand operation, expand into other geographical regions as the case may be. So this can lead to long-term growth potential and higher stock valuation as investors expect future, earning increase. There's higher tax as a deterrent, higher tax as a deterrent. Higher taxes can discourage business expansion or investment in research and development, leading to slower growth and reduced future earnings expectation, which can negatively affect stock prices. Whenever there's an increase in tax, it will prevent companies. It will affect companies' growth. Actually, the company will not grow as expected. And with a lower level of growth, that will then go a long way in actually, affecting the stock price negatively. And so you discover that all these factors are what, promptly affect a company somehow. And not only that, this number 6 says a short-term versus long-term effects. So in this case, discover that in a short-term context, tax reforms often lead to immediate market reactions, particularly if the changes are perceived as pro-business, that's in case of tax cuts. And so there's also anti-business in terms of tax hikes. All right. And so these movements are often amplified by speculations about the long-term impacts of these policies on, on the overall health of the company concerned. Let's look at long-term adjustments. So over time, the market adjusts to the long-term effects of tax reforms. If the tax cuts leads to sustained economic growth and higher earnings, stock price may continue to rise. Definitely, if the tax cuts will then affect the economy positively, discover that the stock price will rise as a result. And number 7 is impact on foreign investment and competitiveness. Impact on foreign investment and competitiveness. So let's look at corporate tax cut in this regard. So lowering corporate taxes, lowering corporate tax rates can make a country more attractive to foreign investors. The lower the corporate tax rate, the more foreign investors get attracted to the country concerned, particularly for multinationals looking to maintain or to maximize profitability. And in case of tax increase, conversely, high taxes, especially in foreign earnings or cross-border profits, can reduce a country's competitiveness, causing multinational companies, to shift to regions of lower tax burden. All right. So when it comes to corporate tax, it plays a significant role in the economy, in the stock market, as well as in attracting foreign investors to a given country.